Howdy, Jacob here. Today we're looking at Aehr Test Systems. We see that they're in the semiconductor equipment industry for just under $500 million market cap and enterprise value. Looks like they have massive growth, but similar to some of the other semiconductor stocks, we see that it can be pretty volatile with earnings and pretty cyclical. When they do produce, like they have the last 2 years, return on invested capital is absolutely massive. Um, what else do we have here? Currently 25.5 PE. Let's look at this shareholder. So 5.7% held by insiders. Okay, that's a decent insider ownership. For smaller companies that are under $1 billion, it's definitely better to see double-digit percent insider ownership. But nothing wrong with that. We do see that their stock-based compensation is upwards of $2 to $3 million, and they also are increasing shares. So the shares outstanding is probably jumping up like crazy. Okay, so last 10 years, 11 up to 28 million shares outstanding. And recently, I guess 6 million shares over a 5-year period is not an incredible amount when the base was 22 million. The balance sheet looks very attractive. 48 million extremely liquid assets in short-term investments, cash equivalents, and 23 million total liabilities. So this company, as long as they keep producing positive cash flow, is not going to be going under anytime soon based on the balance sheet. Their use of cash flow really is just they've only made cash flow the last 2 years, and they've made investments, and then outside of that, it looks like they've been issuing shares to cover some of their losses. So let's start making some assumptions here. I think, revenue growth, it's an extremely small business. I heard that semiconductors, CAGR is going to be double digit over the next quite a while. So it probably wouldn't be surprising if this company grew at maybe 12% a year for the next 7 years. I'm going to probably be a bit more conservative than others as for the margins because, one, their free cash flow margin is lower than earnings, and then two, they've only had 2 years of positive earnings and cash flow. So I'm just going to be a bit more restrictive here in assuming maybe 15 and 10%. And this is where, again, the art is, and this is why I want you guys to do these types of calculations with me, is because I might be a lot more conservative than you, but I hope you review it in conjunction with your own analysis and just understand why I'm doing the margins that I'm doing. Because with only 2 years of history, that could just mean that their margins are actually going to expand from here because they're finding way more highly margined businesses to go into, and they figured out how to monetize everything. But it could just be part of their cyclical business where the last year or two in semiconductors, they could just sell for any price and anyone would buy anything because you say AI or electric vehicles and you jump up like crazy. And so I feel like there's such a balance to it. I tend to be on the conservative end of those assumptions. And then for share change, I'll probably assume 3%. I think that's pretty light actually, since they've just been issuing quite a bit of shares in relation to. Their stock-based compensation is 3 million in relation to 500 million. That's not even a percent, but then they've also been issuing shares to go along with it. So I think 3% I'm comfortable with. A lot of growth here. So maybe I'll put 18, 7 years from now, PE. If they do become a more established business, 12% a year, their revenue is going to be, what is this? Only 180 million. That's still a pretty small business, but the semiconductor business is can get a little crazy. There's so many people. At the high level, you got your AMD, Intel, and then your GPUs and such. You have NVIDIA and stuff, but it's surprising how many more semiconductor companies there are beyond that. And I might do a little bit higher. I haven't done this recently, but I'll go a little bit higher based on the fact that there's just a lot of unknowns here. And with more unknowns, I want a higher margin of safety. And I only put in a little bit here because their balance sheet is so good that this margin of safety is really just me not knowing their future earnings and cash flow. But I think I'm comfortable with these assumptions. I'm basically saying they're going to reinvest a lot of their money to a lot of growth. And then beyond that, this is going to be stock-based compensation, maybe a little bit of issuance of shares to help reinvest and leverage the reinvestment without going into debt. But this gets us to a final price. It needs to fall 80% before you get a 16% return given these assumptions. I think I have fair assumptions here. Again, I'm probably lighter than most people when it comes to both margins and revenue growth, but I tend to be on the more conservative side, and I want a company to be a screaming deal when I buy it. So hopefully I'm going to enjoy the video and it's the rest of the day. Thank you.